Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments, and your retirement here on the show. Our show is all about saving money, building up wealth, and understanding the very complex world today, trying to make it simple. And our motto and our philosophy is to save aggressively and invest conservatively. That's the key to building up wealth over the long term. Save aggressively, invest conservatively. That means always putting away as much money as you can in your qualified plans. Get that tax deduction, 100% write-off, up to the limit, and then you get tax-free growth over the tenure of your life. Actually, I was going to say work, but the tax-free growth continues when you retire. Now, then what you have to do is from there. I just took a sip of coffee. You want to, conservatively manage the funds. And in this world today, you're coming up on retirement. It's much more challenging. Over the last, 20 years or so, we've had basically low inflation. Up until recently, low inflation, 25, 30 years, low inflation. We've had the S&P 500 going up, beating everything else out there. And you just sit back and everything is great. That world has changed, and now we're running up massive debt. Joe Biden came into office. The debt was about $26 trillion, 26 and some change. Now it's like 26, 27 trillion. Now it's about 36 trillion. It was a 31% increase in the debt. We're now borrowing at a rate of $1 trillion every 100 days. Now, if you count to $1 trillion, it takes, I want to say it's like 30-something thousand years to start going 1, 2, 3 to hit. And yet here we are blowing through that much money every 100 days. And so here we have a situation where President Trump comes in, they get into office, then they basically realize they've come in and everything's been pawned and the silverware's been sold off and they got no money in the bank and it's trouble. And so here we are today. Last Friday, not this most recent, but the Friday before, late in the day, the S&P Moody's downgrades the United States debt to AA1. Now we've been downgraded before to by Fitch and at first by Standard & Poor's in 2011, but we're always able to, even after those downgrades, say, look, we're AAA rated. We're not anymore, and it's a wake up call of the direction that the country has gone. Even with Trump cutting in the Doge Commission and reducing spending, our deficit's still likely to be $2 trillion this year. Keep in mind, the year started in September of last year, and Joe Biden was dumping huge amounts of money, spending it like crazy for the election. As a matter of fact, I think after the election, between the election and when Trump came into office, he moved, I think, $90 billion into accounts that no one even knows who's in control of the money. They just shifted. They were just throwing money all over the place. And now all of a sudden we're downgraded. We're AA1. It's not a good situation. And so where do we go from here? A couple thoughts on that. Looking at it, I would really have liked to have seen a bigger reaction to the downgrade. It was sort of, the downgrade happened, and it's kind of like nothing. When market went down, it came back up, nothing to see, and it's kind of drifted down. The House passed the budget with actually a lot of spending cut, not enough spending cuts, and candidly, the tax cuts for corporate America and various things like that, which, look, hey, I'm all in support of that. But when you're dealing with these type of deficits, when you're dealing with downgrades from AAA, it's a really serious situation. And I don't think it was taken as seriously as it should have. Well, we were downgraded 10 years ago. Well, the reason why they downgraded early is they wanted at least 10 years to roll off to get rid of all the derivatives that in all the different types of contracts required AAA credit, because if they lost the AAA credit, it would have just caused chaos in the financial system. But nobody thinks we're on the right track yet. I mean, we've got to make much tougher cuts in government. So I think government spending from when Joe Biden came into now is up about 20%, 21% in four years, and it's kind of, we really don't have a taxation problem. The amount of money that the government takes in, I want to say, is about 17. This is off the top of my head, but it's 17.5% of GDP. We're spending about 20, 21, 22% of GDP. And the interesting thing about that is, look, that 17%, that number or around it has been pretty constant for a long time. And it's the spending that just keeps spiraling out of control. It's basically a candy store up in Washington, D.C. The spending is out of control. I think it's 7 of the top wealthiest zip codes in the country are in Washington, D.C. And one of the shocking things that's really come out is the level of corruption and malfeasance, just reckless spending has stunned. If you talk to the Doge Commission, the thing they all say is, wow, we had no idea it was this bad. But if you just look, you start thinking, wait a minute, we have the finance industry, we have the movie and entertainment industry, we have the oil industry, we have all these different industries around the country where people are making huge amounts of money, and yet the top 7 of the top 10 are in Washington, D.C. And I've said this a couple of times on my show, but it still just boggles my mind. I never had any idea, as huge a critic as the Max Out Savings Show has been, it's just the sheer amount of malfeasance going on up there, the contracts, the just ridiculousness of the whole thing. And then you had NGOs, which is a non-government entity. You had these people parading around with their endowments and their foundations and stuff doing all this good, and all of a sudden it comes out that they've been getting, they'll put in $10 million from the foundation and get a $30 million, $50 million grant and pretend like it's their money. And rather than giving away and doing good for the American people, these people were claiming they were, somehow spending their own money on this stuff. And they were going around, the same exact people doing this were going around the country convincing all these wealthy people to disinherit all their children and put all the money in a foundation and give it away. And it turns out many of these people weren't really giving away that much. They were getting government grants, giving that money away, and keeping the money for themselves and their foundation. It was, the whole thing is just Romanesque in a level of complete destruction. I mean, you really have to, I've said this in the show, you have to go back to Roman times to understand the just absolute, just orgy almost of out of control spending that has occurred up there. And so here we are today. We're downgraded. And the market's only down. Look, nothing to see. That's not right. Look, these things have big history moves in long cycles. Things don't happen in a week. They happen over time. And this is not a good situation at all. It clearly, no one is surprised it happened, but the concern that we have is I really would have liked to have seen a lot more sense of urgency with the Republicans to get much tougher on cutting across the board. There's so much, Medicare fraud there. There's, the Social Security, they're letting everybody come on Social Security now, calling this they actually call it the disability in certain areas. I'm on the disability. Well, it looked perfectly fine to me. These people don't want to work. They get on that. And so then people that have put all their money in Social Security working all these years, they come up to retire at 65, 66, whatever, 70 years old. And there's not going to be as much money for them because these people have been, claiming all types of things ahead of time. So what I want you to understand is We would have liked to seen more of a sense of urgency. I don't think this is over yet. The Senate bill is not passed yet, and I think the stock market is really whistling through the graveyard. Now, what are the positives? The positives are Donald Trump has a plan, and Donald Trump, the plan is pretty simple. Is they're looking at the debt and go, look, there's no way we're paying down this debt unless we grow our way out of it. It's sort of like, when you take out a little, you're younger, you take out a little more debt, than you should have, run up the credit cards or getting over your head on a house or whatever. And then after 2 or 3, 4 years, 5 years, you're making more money, you get some raises, and you cut back your expenses, you get some raises, and then you sort of grow your way out of the debt. At the time that that $65,000 you spent in a house that seemed like all the money in the world, you're making more money, the house goes up in value, and everything in the ship rights itself. And so their plan is we have to grow the economy, and we have to raise revenue. So Trump goes, well, why don't we raise revenue from tariffs? And two things happen, and this is really remarkably well misunderstood by Wall Street and the mainstream media. Is tariffs create income, which is revenue, just like taxes are revenue, and there's just not a grasp for that at all. All they look at is, oh my God, the taxes are going to go up. You're going to hurt margin. You're going to hurt corporate earnings or corporate margins, and we got to stop that. But Trump goes, hey, well, why don't you sit there and move the factory back to the United States of America? He goes, well, it'll cost us too much money. Well, we have to raise the price. Well, you either pay the tariffs and raise the price, but why don't you guys, with your margins at maybe 30%, take it down a little bit and give the American people a break, and you can eat some of the cost of the tariffs. And so Wall Street's all upset. The tariffs are the worst thing in the world. But the important thing to understand is the tariffs are going to bring in revenue. They're going to bring companies putting factories back in the United States. Look, in some cases where there's a big, let's use automobiles, there's a big tariff on automobiles. Well, they're negotiating that. And some of the negotiations might be, well, I see you're bringing 50,000 cars in the United States. Tell you what, if you put a factory in here that produces 15,000 cars here, we might just waive the tariff, or reduce the tariff dramatically. You can still import, a certain percentage of the cars, maybe 35,000 from over in Japan or Europe or wherever, but we want to see another factory here. That's the type of thing. That's going to grow the economy. That's going to grow us out of the debt. That's the plan. That's part of the plan. They're also going to prevent countries from depreciating their currencies to compete against it. They're going to adjust the tariffs on that. The second part of the program is, corporate America is going wild about the tariffs, but what Trump is going to do, he's going to try to give them a tax cut, and he's going to reduce huge amounts of regulation and permitting times to build factories back here, to put the factories in, to make things easier for working people, easier for factories here. I talked to a bunch of cousins in upstate New York. I'm like, you guys have the prettiest place up there. It's gorgeous. It's cheap to live here. I can't figure out why there's not more factories. Like Ted, nobody wants to come to upstate New York. The taxes are super high. The regulations from New York City are so onerous. Nobody is going to put a plant in up here. Well, he's going in other parts of the country, and they're working to reduce the regulations, reduce the permitting time. In some cases, it takes 4 years just to get the permits. So what President Trump is going to do is he is working to grow the economy, to get factories back here, manufacturing back here, jobs back here, and rebuild the United States economy, and then we grow our way out of the debt. The alternative is a hyperinflation, which inflates away the debt. So we'll see what happens, but there is a positive in place. And the really sad thing is, rather than constantly attacking President Trump, they should look at the programs and see if we can rebuild the United States. But Unfortunately, that's the world we live in. We're going to discuss some of the outcomes on how it's going to affect your retirement after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. We're just talking savings investments and really how, what is our situation, which is not good right now, way over too much debt, out of control spending. What are we going to do about it? And President Trump has a plan in place to do that. He has a plan to build out things and to fundamentally change the United States of America. And so I think it's got a good chance of working, but it's not going to be easy. And this is something we're going to have to we want to kind of continue to watch and really understand what's going to happen and where it's going to go from here. Looking forward, as we said, the market's had somewhat of a sell off. Some things are continuing to go up. If you look at the number one asset year to date, it's really been the precious metals. It's been gold. Gold's up about 28% or so, which is just extraordinary in what we're seeing. And it's just, and again, this is a concern. This is like, oh my gosh, where am I going to put my money? What if something goes bad? What if the United States goes into hyperinflation? What if China takes over? What if the war breaks out with Russia? And the Ukraine war gets worse. What if Iran and something happens there? I mean, it's just the list goes on and on and on. But I think it really has to do with the sheer amount of money in the world, and I think people want to. They want to. You can't print any more gold. Keep in mind, this is not just the United States' problem. I mean, Japan has this problem. Europe has this problem. All these people have really, things have just spiraled out of control. If you look at the one country that's really doing much, much better is Greece. Greece went through this problem, a decade or so back, there was huge problems. They nearly defaulted. They cleaned up their act. They cut huge amounts of cut in government spending. They've been upgraded in value. The yields have gone down, and they've improved their situation. You can get out of these problems, but you have to be serious. You have to reform the government. And this is where the Doge Commission, this is where the other things in. Japan, Japan is a problem. Their debt is ours is about 125% of debt to GDP. This is typically the number where countries get in trouble. I mean, it's if you read Rogoff and Reinhardt's book, it's really right in there that the countries have trouble and it becomes a downward debt spiral. There's stuff with that a number of people have done the research on that and those are the numbers, and we're in that range. Japan, it's about 200%, over 200%, 220. They've been able to get away with it for a while because it's kind of a closed society. They do, they do what they're told, and they can just, and the government keeps buying more and more bonds and kind of printing money. But interest rates are going up there, and I think if you look at the 10-year bond, rates are going up globally. And this is an issue. If you look at the 10-year bond, it's yielding about 4.5%. The 30-year bond's over 5%, and this is typically where people get in trouble. The Japanese bond, the 30-year is at 3%. This was at 0.19% back around 2019. 0.19 is at 3%. They have 200%. They can't afford this percent debt to GDP. They can't afford this, and so there's a real possibility that something blows up in Japan. And why are interest rates up now? And I think this is. Do we have a call coming in? Okay. Hey, Charles. Happy day. Well, that'll be Monday, but it's the weekend.
Good morning, Ted. And yes, happy Memorial Day to you as well. I have just a question on the tariffs. And I guess the question I have is how will, when this stuff is negotiated, do you see any way that the countries are not going to try to divert their goods to countries with lower tariffs? And I'll use an example. Say, with China, they negotiate at some point. They're going to negotiate some agreement with China. But if, for example, let's just say that Vietnam has a negotiated lower tariff, what is to keep China from funneling their goods over into Vietnam? In other words, is this just a porous thing? Can that really be controlled or not?
Well, that's the hard question, and that's really what to unpack that question is a really interesting question, Charles. China has been doing that. China's been kind of routing a lot of their products through Vietnam and a couple other countries, and and maybe what they do is if it's a lawnmower, just an example. They build the lawnmower in China. They build the decking in China. They build everything in China, and they ship all the parts over to Vietnam. And the Vietnamese kind of just, screw the thing together and then ship it over here, and they claim it's made in Vietnam. And the U.S. is onto those tactics, and this is kind of what a lot of it. This is why Trump was pretty tough on Vietnam with pretty high tariffs, because they were doing that. I mean, and Nike went wild about it. Well, the problem was it wasn't Nike; it was a lot of other stuff was bleeding over into Vietnam. They were slapping a made in Vietnam tag on it, even though it was made in China. And so this is what Trump is watching that. This is why they're setting these tariffs in different countries to stop that. The other thing that's happened is along those lines is China is kind of pushed back, and this happened under Trump the first time. And they raise the tariffs here. China starts selling the products elsewhere around the world to other markets. And the problem is they're running countries around the world they're taking factory jobs from other countries now and keeping in China. So China is the real issue. They have way too much excess manufacturing capacity in addition to ridiculously be built on buildings. And so they're trying to move that those sales elsewhere. And this is what's causing the problems. And this is kind of the lever the U.S. has with all the Europeans and other people. Like, look, guys, if this keeps going on, China's going to be making everything, and it's not just us that aren't going to be making it, it's you guys too, and they're seeing it. And so, I mean, this tariff thing is exceptionally complicated. Now, the bullish thing about this is, look, if we can, like the Europeans are classic example. The Europeans are an absolute basket case. I mean, it was basically the globalists, the Davos crowd got in there. They convinced the Europeans to shut down their nuclear power plants, at least the Germans. You know, they got rid of cheap Russian oil and gas. Their manufacturing costs are going through the roof. The thing is, if they can clean that trash, you know, that globalist trash out of there, if they can restructure their economies, they can start making things, they can start buying more from us, and they can start growing the European economy, which has gone nowhere for, you know, a decade or two, as these guys have dismantled basically the industrial capacity in Europe. And so if Vietnam, Trump is going to Vietnam, he says, look, you guys are making a fortune importing us. We want to see you buying from us. And so if we can create an integrated global system that's fair, and where we keep key technologies such as our nuclear technology, our AI technology, those type of things that are key to the U.S. electrical technologies, that in case of war, we have that defense production capabilities and stuff here, then the whole thing will get better. What's happened is this globalization is basically two things have happened. One of them is all the factories have left the United States for cheaper, but really corporate America and the multinationals, this is why the S&P 500 has done so well over the last 20 years, has used this to strip out all their manufacturing out of the United States, not because they couldn't compete, because they wanted higher margins. And now the margins are at record high levels. As a matter of fact, when inflation's come in recently, the corporate margins went up. So these guys that doesn't ever happen. Typically, when inflation strikes, margins go down because companies try to hold the cost down because people can't afford it, and their margins shrink. Well, so all of this stuff, Trump is trying to redo everything because we're on the fast track to go right off the cliff. It's pretty darn close right now. That's a very long-winded answer to your question, Charles. Does that help?
Yeah, I guess it does. It's just it's just going to be a very long. I mean, this will go on. In my mind, it's going to go on past Trump's term. I don't know. You know, hopefully, you know, whoever the next successor is will have some common sense as well. But I guess the bottom line is I just see this as a long, drawn-out process. I mean, the supply chains just, you look at what pre-pandemic, what you used to be able to buy, and now in some cases I see either shortages or it's just the goods have disappeared. And it seems to me that some of these goods have gone to other countries. I mean, I don't know really what's happened, you know, when the Biden administration was in there, but I just think a lot of this stuff got diverted. And, you know, I don't know if there's any chance of bringing that eventually back. I guess it'll come back,
well,
but it's going to take
the cheaper
time.
stuff. The way this ultimately plays out is, look, Elon Musk is building robots right now. They're going to do all types of things. There's going to be robotic assembly lines in robotic factories. And the question you have to ask yourself is, on one side, they go, look, we can't afford these jobs. These jobs are overseas. No one wants to do the factory work or whatever. But the ultimate thing is going to be robotic factories. They're going to turn out huge amounts of products. Now, the question is, they're not going to require a huge amount of workforce. So the question is, do you want the robotic factories in China, in Vietnam, in places like that, or do you want the robotic factories in the United States? Because once you hit the robotic factories, quite frankly, your labor costs aren't a big issue. And so this is, I mean, the amazing thing is the Chinese are putting robotic factories in all over the place, and their costs are extremely low. So we've got to get ultimately the robotic factories need to be moved, and this is what this is all about back to the United States. Mm-hmm. And we're going to have to force these companies. I mean, Apple is out there. Trump said yesterday, hey, I'm going to put 25% tariff on Apple products. Apple's like, we can't build these products back here. the Apple phone's going to cost $3,000. It's $1,000. It's going to cost $3,500 according to some estimate. What type of BS is that? I mean, give me a break. So you're trying to tell me if the product's it's going to require $2,500 worth of labor to put in a phone. I mean, that's ridiculous. How can an advanced society like Korea, which pays reasonably high wages, build all their Samsung phones and send them to the U.S.? But the problem is Apple has very high margins, which they're trying to defend, and they're not willing to put the money in the factories. They've been busily buying back stock. They haven't put money into AI. They've been so busy buying back hundreds of billions of dollars worth of stock that they haven't been investing in the future. But this is the battle. But good question. Thanks, Charles.
Right. Thank you.
I mean, this is you see how complicated this is. So what you got to do is take it back to pretty simple levels and say, look, we're going to put tariffs on stuff. We want things back in the United States. Are we going to stick 50% tariffs on all incoming European cars? No. But the European cars are going to have to let American cars in. They're going to have to make allowances for the VAT tax. They're also going to have to move some factories to the United States. And ultimately, it's going to lead to a stronger country. Now, here's one of the as we talk about these factories, I've been saying there's $500 billion worth of factories come back and to the U.S. Trump's numbers are $1 trillion, $2 trillion. And just to put that in perspective, God, who is it? It's I think Oracle, and there's a whole bunch of group of people. They're putting a $50 billion AI facility in Abilene, Texas. $50 billion. So I said that's 1/10 of it, of what the number I'm using, which my number is probably low after looking at some of the costs of these things. That's going to be built in the U.S. an AI data processing center, massive. They're going to take advantage of the solar and the wind up there. That's very cheap electrical cost to power the factory. And I mean, think about that. Abilene, Texas. The only thing up there is an Air Force base, but that's kind of that shows you the opportunity. But I said 500 billion. It's probably $1 trillion. Other people around the world are spending money. Where's all the money going to come from? And if you look, we've been talking about the Japanese 10-year bond and the Japanese 30-year bond has been moving higher. If you look at the 30-year bond since January, well, let me see here. It's gone from 2 to 3% this year, 2 to 3%. If you look at the U.S. bond, rates were going down, and right now it's about even on the year. Well, supposedly rates were coming down, and instead, in the last month or so, interest rates have been going up here in the United States. Remember, we started the year expecting 3 rate cuts from the Federal Reserve. Rates were going to the Fed funds was going to go down from about 4, give or take, down to maybe 3 or something. That hasn't happened. A couple things: inflation expectations are going up, and which is people are expecting more inflation due to the tariffs. Now, the inflation numbers are some of the highest in 20, 25 years. Well, this doesn't make any sense because we had almost 9% inflation about 3 years ago, on a monthly basis, 1 month, and the inflation numbers weren't so high. So what happened? Well, what we're dealing with is the press is scaring the heck out of people, and all the Democrats are all convinced Donald Trump is going to fail. They're many people in the press are suffering from Trump derangement syndrome. I mean, and I think that's a genuine thing. I don't think that's like a made up. I'm beginning to think it's a real thing, and so they have panicked the American people, and they think we're going to see a massive inflation. But the other – so inflation expectations for all this debt are going up. People are concerned about out-of-control government spending. But the other thing that's not going to be talked about, and we're going to talk about after this quick break, is there's such a demand for money because all these factories are coming back. People are spending more money. There's something called crowding out, and there's going to be such a demand. It's crowding out the government spending or the factory spending or real estate because there's so much demand for money and there's not going to be enough to go around. And this is going to be the interesting thing. We're going to talk about that after this quick break right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400 or visit maxoutsavings.com.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
AM 1070, The Answer.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. We're just talking savings, investments, and your retirement. Dealing with retirement in a more inflationary times, this is something I think going over the next 5 to 10 years is going to be more challenging. And we've been saying this for years. You're going to get more inflation, and you're going to have to be much shrewder in investing your money and in managing money and understanding and how to deal with inflation. It's not just investing for inflation, but also managing it. It's if we're going to have inflation, if possible, you want to own your own home because you can control your costs. Even if once you get over 65, your taxes are somewhat limited, and you can your insurance can go up, but your housing costs are generally fixed. Same thing with an automobile. You want to buy an automobile that has a real good quality track record that's going to hold up real well. So you look at it. Long term, maybe it's a Ford truck or something, or a Honda or a Subaru or an Acura, something like that. These things tend to not break down, and so it controls your cost. Same thing with health. We talked about healthcare is so important. Robert F. Kennedy's working on MAHA, which is Make America Healthy Again. They're going to clean up the food supply, cut down on ultra processed food, but it's important to eat well. Watch what you're eating. Avoid these seed oils. Stick with things like olive oil. It's a little more expensive, but it's super high quality oil. It's going to improve your health. You want to eat well. Want to exercise. Even if it's just walking around the block a few times every day, these things make a difference. A couple things happen. You're going to feel better. You're going to have more energy. Your health is going to be better, so your health care costs are going to climb, which is going to – so by working out, eating well, your health care costs go down, which means you can stretch your dollar as a retiree much longer, and you're going to live longer. So it's kind of a win on all fronts. So when it comes to dealing with an inflationary world, where things are tighter and stuff. It's not just investing, but it's also lifestyle. It's also locking in expenses. Any way you can lock in an expense. It's like getting a Honda. I was just making fun of one of my sons who's driving his Honda into the ground. Like, he's getting in the car, and he goes, "Dad, it's still running." Da-da-da. Like, but the things run forever. And so if you can get something like that, by fixing your costs and keeping costs down, healthcare, car costs, housing, everything, that makes a difference, and that helps you out. That lets you keep a higher lifestyle at retirement. Something to think about. Again, it's not just investing, but it's throughout your life. That's what improves the quality of life, and it'll give you more funds to spend. So anyway, it's a holistic look at health at retirement, and keep that in mind as you retire. Now, we're just talking about, is there going to be some crowding out where there's so much demand for money for factories and for other programs? And I think that's the case. I think this is why we're seeing interest rates go up around the world. It's not just the United States. As we said, I think Japan is possibly a bigger danger of blowing up. If Japan starts blowing up, the Japanese, in order to support their bond market, would have to sell treasuries, which would push U.S. Treasury prices higher. If they're selling treasuries, then they've got to buy Japanese yen to convert over, and that's going to push down the dollar. Keep in mind, the dollar had one of the worst starts to a new year in decades here recently. Well, one of the things that happened is a couple things. Trump came out with this tariff, so all the Europeans in a huff, decided to pull their money out of the United States, and at the same time, the European markets were doing better, so money went over there. Over to the people were buying, selling dollars to buy euros to purchase, Shell stock or Nestle's or somebody like that, and it pushed the dollar down. So these trends affect things. So if the Japanese market, if the bond market starts imploding, which it appears to be doing, they're going to have to try to stabilize. It's doing that right now. They're going to have to move to stabilize. It could lead to more selling of treasuries, more pressure. All of this is not the best for the stock market because a couple things. Higher rates, once the 30-year goes over 5%, it becomes a real competition for stocks. And this is something, I think we're going to have to watch here closely and see. It's also going to pressure real estate. I mean, it doesn't help, when interest rates are over 5-year and 30-year, that doesn't help people borrowing money on mortgage loans because everything is priced off the Treasury market. So this is something we want to watch. A couple thoughts. When it comes to the market itself, typically the S&P 500. Let me see here. Well, we're down year to date, and the S&P 500 is down year to date, and it's come back up. It's dominated really very much by these big mega cap tech stocks. I mean, we've written about it in the Max Out Savings Report here, for a year or two. That look, these valuations are extreme in this sector. It's we talked a little bit about Apple earlier. All the margins in these companies are way out of line. The valuations are too high. The capitalizations really worry me because they're so massive. It's difficult to keep supporting them. In many cases, they're held up by gigantic stock buyback programs. Just to use Apple as an example, if Apple's going to have to be building plants in India, Apple's could lose $20 billion a year from lawsuits. I mean, not from lawsuits, but they get about $20 billion a year from Google. So every time you use Safari, you're really using Google. And Apple has not invested in AI like they should have, and now they're in trouble. And so they're going to have to cut back the stock buyback program. So all these demands for things, higher interest rates pressure stocks. If building new equipment, that means, again, it's kind of a crowding out. There's a demand for money. So I've got a demand. Well, Ted, do we sit there? Do we build this new factory, or do we keep buying back stock? You can't do both. You're going to have to pick. Let's tell you what. Let's cut the stock buyback program 20%, and then we'll put the money in a factory. That's what you're going to see across the board, and I think the S&P 500 is top for a while, and likely to go down and ultimately retest those lows back in April, and so it could go much lower, and so. This is something you're just going to have to watch. I mean, we have rising interest rates. We have the currency in trouble. We have tariffs in place, which are going to pressure margins. It's just a lot of stuff. And again, building all those factories takes money. If you got to build a factory, you can't go launch big stock buyback programs and everything else under the sun. And so I think you've got to be very cautious in here. We continue to like precious metals. I mean, it's hit a new high. The gold is I still think silver breaks out. Silver's kind of lagging in here. I've watched silver for I don't even want to say how long on the show, but and it's had several big runs to $50, and if you start putting a $50 number, that was 10 years ago or 30 years ago, doing a little inflation calculation, this thing has the ability to just go a lot higher. And quite frankly, at 33.5, if you do some inflation adjustment, it's really hasn't really moved that much. And I think the price of gold is getting as the higher gold gets, the more favorable silver gets, particularly for investors. If I'm a multi-millionaire, I can go around buying gold coins all over the place. But if I'm not, the 1 ounce gold coin is $3,400. I can go buy 1 ounce of silver for $33. It's 1/100th of the price. And people are going to gravitate towards that. The gold to silver ratios, right now it's still close to $100, which is a very high. Typically, it's in the 60 to 70 range is kind of the mean, number, and so I think there's real opportunity there. We just talked about a $50 billion AI processing center in Abilene. Well, that's all. How much copper do you think they're going to use for that, for wiring in there? How much copper are they going to use for the, for the connectors, the power lines, the generators, the wind turbines? Enormous amounts of copper, and so I do think I think commodities still haven't gone up as much as they should have in a world where the dollar's had the worst start in decades. Do I own copper, gold, or silver, which is going up, or do I own the dollar? I think people are going to be more comfortable owning that and stockpiling it. And I think this is going to go to general across the board. The commodities are still going to be a pretty good place to be, because remember, China's kind of it definitely is in an economic slowdown. They're going to have to try to get things going in China to some extent, and that's going to use more commodities when they do. Okay, yeah, I'll take a quick call. Okay, yeah. Welcome to the Magazine Show.
Yeah, this is Chuck, Ted. Listen,
hey, Chuck.
I was just curious that since Japan has 250% of debt to GDP, and of course the United States is really bad, I agree with most of what you've been saying on the radio. Why has the inflation rate been so low in Japan? That's what I don't understand.
That's a very good question. They've been able to control things. The corporations, their margins are pretty tight in Japan, and they don't go around raising prices, to hit quarterly numbers. And so they haven't been asking for raises. That's starting to happen. The key thing is, this is a good question actually, the key thing in Japan is the cost of rice has gone up about 50% here this year. Or I don't know, that's not exact. That's kind of just a ballpark number. But and that has freaked out the Japanese, because rice is almost sacred in the country, and they're all of a sudden the inflation expectations are going through the roof over there, and corporations are now having the Japanese people are starting to ask for more raises and stuff, and so I think you're really starting to see inflation take off in Japan now.
Okay, that makes sense. All right. Listen, thanks a lot. Listen to you all the time. Thank you so much.
Thank you, appreciate it. Yeah, Japan is a very homogeneous society, and it's and they're able to really do stuff. But there's real pressure in Japan. The minister of agriculture actually resigned because he says, well, I don't usually buy rice because people give me rice as a gift because they're like, thank you for coming here, minister. Here's a 10-pound bag of rice. Because rice is so important to the Japanese, but the price has gone up, and he said, I don't know about it, and so he was forced to resign, and so they're really starting to understand. But this debt problem in Japan, if this blows up, like I said, if they have to start repatriating, selling treasuries or selling stocks, repatriating money back to Japan to stabilize things, that's probably, when you talk about interest rates, the real smart money out there is going, hey, keep an eye on Japan. Watch the Japanese. This could be a problem over here. They're saying, yeah, rates are going up in the U.S., but this is the one could sneak up on you. So we'll see on that. This is going to be interesting. So again, I think you want to have higher levels of cash. I'm just not a big fan of the big mega cap tech stocks. I think NVIDIA's got a really good case. Things are going to hold up. The rest of them, really, Google, Apple, Meta, Facebook, Microsoft, they all have problems, the antitrust problems. They have, the AI is fundamentally AI is going to hit the tech stocks worse than anything. OpenAI just paid $7.5 billion to, I think it's a guy named Ives, who's a designer for the Apple phone, for his company. Why would you do that? Because the future is going to be an AI thing, as we've talked about in this show. It's going to be your own little AI, and you're going to be talking to it. It's going to protect your privacy. It's going to watch out for you, and it's going to be like your own little personal helper, and that's going to be a massive game changer. It's going to shut out Apple. It's going to shut out Google. It's going to shut all these guys that are basically selling your data and selling access to you out there, and that's going to be a game changer, and it's going to hurt their margins. But anyway, so there's a lot of opportunity out there. I think you want to have higher levels of cash right now. You want to spread your risk across multiple assets because there's a lot of multiple outcomes. Anyway, we're going to write about this in our Max Out Savings Report. I've got it all in the computer. It's going out in the next 2 days. It's all somewhat proofed up and ready to go. Just go to our website, maxoutsavings.com, if you'd like a free copy. If you need some help with retirement, have an old 401k or retiring, you'd like to talk to us here at Max Out Savings Advisors in Houston, just go to our website, maxoutsavings.com. You can request a free appointment. I'll sit down with you and we'll go over, take a look at your situation for retirement. It's maxoutsavings.com. In addition, I hope everyone has a great weekend, a Memorial Day weekend, to honor our fallen heroes in this country. And remember our motto in philosophy, which is to save aggressively and invest conservatively. That's the key to building up wealth over the long term. Save aggressively, invest conservatively. Take charge of your future, protect yourself, and you'll be able to ride through whatever changes come. And we'll try to keep you posted. We try to get you ahead of all these big changes here on the Max Out Savings Show. Thanks a lot for listening. I'm Ted Gioka. I hope everyone has a great weekend.